Good afternoon, everyone. Dollar INR has suddenly become very volatile, and I wanted to share my thoughts. So let's quickly get into what's actually happening in the market. So this is the dollar INR offshore chart. Okay, so it's like 24 hours. So as you can see, the prices has quickly moved up. So if you see in just the month of July, we were at around 85.50 beginning of July, and now we are at 87.50. So in just about 1 month, we are about 2 rupees higher for every dollar. Now this is the technical chart. If you slightly look at a longer term period, earlier the highest, the all time high for dollar INR was around 87.95, and we are very close to it. We are around 87.50, 60, that level. And if you look at also the long term moving average, which is the purple line, that comes around 85.50. The indicators are certainly overbought. The prices have gone very high, so the indicators have also gone very high. This is one particular indicator that we track very closely. It is the difference between that long term moving average and the current price. So it tells about some indications on price extremes. So that red line, if you see here, is just the difference between the moving average and the current price, and that has reached, if you see, multi-month highs. Okay, so price has gone to an extreme, as we can see like this. The RSI and this particular difference indicator all are indicating that prices has reached to a level where it is very attractive for dollar exporters to sell. I will come to that part slightly later. Let's look at the onshore chart. Okay, this is the dollar INR onshore chart, and I wanted to show you all the gaps that are happening here. Okay, so if you see the gap here, sorry, I'll just select my pen. If you see the gaps here, then there is another gap here. In fact, there was a gap that was formed today morning also, but it filled up intraday today. So gap filling is a very important component in the dollar INR analysis. So what we feel is, since these gaps have formed consecutively, there is a good chance that these gaps might fill up, which means the prices might come down and cool off. But bottom line, what I wanted to suggest is, since these gaps have formed and since this is the all time high, this region is going to be a very important resistance region. So what does that mean? So if it is a resistance region, prices might go higher, you never know. There are just too much of geopolitics happening. Trump has imposed a 25% tariff on all Indian exports to US, and penalty if we buy oil from Russia. So there is a lot of geopolitical uncertainty happening. Prices can go anywhere, no one knows the future. But if you look at technicals and fundamental factor, this region looks to be a very good resistance region. So we very strongly recommend all exporters to hedge. I will show you what I have. So this is a typical forward table what we have. So my strong recommendation to all dollar exporters is to sell your future receivables. If you look at the spot, we are around 87.50, 60. These are the forward premiums for each respective month, and we get forward rates of 87.90, 88, and even 89 for 10, 11, 12 month forward. So those levels are incredibly attractive to lock in your future receivable prices. I am sure your budgets must have been much lower, so you are locking in a good amount of profitability at these levels. So very strong recommendation to all dollar exporters to hedge their forward receivables. Okay. Now I wanted to also give an indication to the importer side as well. Okay. Now as I have seen here, the prices have gone higher. It is very high. It has reached an extreme, as I suggested here. There are multiple gaps that I showed here. Okay. So what my recommendation to all dollar importers is, prices have gone high. They will not go high forever. Okay. If you see here, when it had gone here, it had come down also. Okay. So markets are always two-way. So for dollar importers, here I have highlighted in green, to all dollar importers, you postpone your import payments by taking an import funding. So very strongly we suggest that importers who have payments due in the next 1 to 2 weeks should take import funding, take buyer's credit, and postpone their payments for 2 to 3 months. As and when the prices cool off, we have seen prices cooling off towards the long term moving average, as and when prices cool off, you can hedge at those levels. So if you're taking an import funding at, let's take 87.50.60, and in a month or so the prices cool off, which most probably it will, then at 86.50, 86, those levels you can look to hedge your liabilities. So you avail your funding when the prices are at high levels, 87.50.60, and when it cools off and comes to 86.50, then you can look to hedge your payables, these payables. So you are not feeling the pinch of paying such high prices for every dollar. Okay. So, and for exporters, forwards can look at options as well. Options are slightly expensive, 40-45 paisa for a month, but again, if the prices have moved up 2 rupees in a month, paying 40-45 paisa is worthwhile. Okay. So exporters, please sell using forwards and options, and importers take buyer's credit. Okay. So that is it from my side. To get more such updates on Forex markets and such insights, please scan the QR code and join our WhatsApp community.